In 1981, if you put $10,000 in a savings account in America, you could earn more than 15% a year. 15. Do nothing. Take no risk. Just let the bank hold your money and watch it grow. Today, that sounds almost mythical. But here's the strange part. Even back then, that saver still lost. Not because the bank failed, not because they spent too much. Because while they thought they were protecting their future, something else was quietly eating it alive. And that's the part nobody teaches you. Saving money feels like progress. It feels disciplined, safe, responsible. It feels like the kind of habit rich people must have. Maybe not, because the people who become truly wealthy usually understand something most people don't. Saving money can protect your life. It rarely transforms it. And the difference between those two things is everything. Let's start with a person. In 2010, a 25-year-old saves $500 a month. Nothing dramatic, no crypto, no startup, no crazy risks, just $500. Every month, for 30 years. Sounds smart? At 55, they should be in great shape, right? Maybe. But here's the catch. That answer depends less on how much they saved and more on where the money sat while they were living their life. That's the first twist in this story. Most people think wealth comes from what you put away. In reality, it comes from what your money does while you're away. That one idea splits people into completely different futures, because money has two forms: stored labor and active labor. Stored labor is cash. It's your time frozen. You worked, you got paid. Now that effort sits in your account, waiting. Active labor is different. That's money that has been sent back into the world to work on its own. Into businesses, stocks, real estate, systems, anything productive. One sits, the other moves, and in finance, movement matters more than almost anything. Imagine hiring 1,000 workers, then locking them in a waiting room. They're safe, but they build nothing. That's what most people do with money. They collect it, protect it, admire it, and accidentally stop it from doing its job. Now, to be fair, savings matter. Emergency funds matter. Cash reserves matter. Safety matters. If your financial life has no cushion, every surprise feels like a crisis. But there's a dangerous moment where caution quietly turns into stagnation. And most people miss it completely. Because a bank account gives you a powerful emotional reward. It lets you feel secure without forcing you to understand money. No uncertainty, no complexity, no visible risk, just numbers going up. And those numbers are persuasive, even when they're lying. Because this is the oldest trick in personal finance. Money can grow numerically, while shrinking in reality. Take inflation. Not the dramatic kind from history textbooks, the ordinary kind. The kind that makes groceries feel a little crueler every year. The kind that turns rent into a monthly ambush. The kind that slowly makes your old salary feel like a joke. Inflation doesn't rob you like a thief. It ages your money like milk. Quietly, patiently, without asking permission. That's why saving feels so deceptive. Your bank balance can stay exactly where it is, while your future gets more expensive around it. And if that sounds abstract, here's the real-world version. Between 2000 and today, the US dollar lost a huge chunk of its purchasing power. A dollar still says $1. But it does not live like one. That's the illusion. The number stays. The power fades. Which means if your strategy is only to save, then over time you are not simply standing still. You are moving backward in expensive slow motion. This is where people usually say, Okay, fine. But saving is still better than spending everything. Of course. But that's a very low bar. The question is not whether saving is better than chaos. The question is whether saving alone can create wealth. And this is where the answer becomes uncomfortable. Because saving has a ceiling. Wealth doesn't. You can only save what you do not spend. Which sounds obvious. But hidden inside that obvious truth is a trap. It means your upside is limited by your paycheck. Your savings can only grow as fast as your unused labor. That's it. You can cut expenses, cancel subscriptions, skip vacations, stop buying coffee. All helpful. None magical. There are people who genuinely believe financial freedom is hiding inside smaller grocery bills. Maybe not. Frugality can create margin. It cannot create scale, and scale is where wealth begins. This is why two people with the same income can end up in completely different worlds. One person saves $500 a month and leaves it in a low-yield account. Another saves the same amount but buys productive assets. Same discipline, same monthly sacrifice, different destination. At around 8% annual growth, which is roughly in line with long-term stock market averages before inflation, that second path changes the math completely. Over 30 years, $500 a month doesn't become a respectable little pile of money. It becomes a machine, roughly $700,000 or more, depending on timing and returns. That difference is not about being smarter. It's about understanding the game. Cash stores effort. Ownership multiplies it. And if that sounds too simple, look at Warren Buffett. Buffett is famous for investing. But that description is too small. His real genius wasn't making money. It was understanding that owning productive assets beats storing cash over long periods of time. He didn't become Warren Buffett by saving Berkshire Hathaway's cash in a giant vault and feeling responsible. He bought ownership, over and over, because ownership is the mechanism that turns patience into wealth. That's the second major twist. People say money makes money. Not exactly. Owned assets make money. Cash alone usually doesn't, at least not enough. Not anymore. And this is where fear enters the conversation. Because the second you move from saving to investing, people hear one word, risk, and they're right to hear it. Investing has risk. Businesses fail, markets fall, prices swing, bad decisions hurt. But here's the uncomfortable irony. People are terrified of visible risk, while calmly accepting invisible risk every day. A market crash feels dangerous. Losing purchasing power for 20 years feels normal. Starting a business feels dangerous. Depending on one employer for your entire future feels normal. Owning assets feels uncertain. Needing to work forever somehow feels practical. Maybe not. Sometimes what looks safe is just familiar. And familiarity has fooled more people than danger ever did. The rich understand this at a very deep level. They do save money. But they do not confuse cash with wealth. Cash is a tool, a buffer, a bridge, an opportunity fund. But not the final destination. The final destination is freedom. And freedom requires something savings alone cannot give you. Leverage. Leverage is when your money, your assets, your systems, or your ownership keep producing value when you are not actively working. That could be equities, rental income, a business, royalties, a brand, software, content, anything that breaks the 1 hour for $1 relationship. Because if all your income depends on your direct labor, then your life has an income ceiling built into your biology. You get tired. You age. You run out of hours. Wealth begins when income no longer depends entirely on your presence. That is why saving money won't make you rich. Not because saving is bad, because saving is defensive. And defense is not how you win a game, it's how you avoid losing one. There's a difference. If you only play defense with money, you may become stable, you may become careful, you may even become comfortable. But comfort and freedom are not the same thing. One keeps the lights on, the other changes your life. So yes, save money. Build the emergency fund, create breathing room. Stop living on the edge. But after that, ask a better question. Not, how much can I protect? Ask, how much can I put to work? Because the goal is not to collect the largest pile of inactive money. The goal is to build a system that slowly removes your dependence on effort alone. That is the shift. That is the line. That is where people stop managing money and start using it. Play it safe. Maybe not. Just save more. Maybe not. Work harder. Maybe not. The people who build real wealth are not the people who hold money the longest. They are the people who understand when money should stop resting and start working. Because in the end, rich is not having a lot of cash. Rich is owning things that keep paying you while you sleep. And the moment you understand that, saving stops looking like the destination and starts looking like the doorway.